The four most dangerous words in investing are, "This time is different." Well, volatility can make even the most seasoned investor uneasy. But instead of retreating into defense mode, what if you leaned in with strategy? In this episode, we're talking about proactive ways investors can go on the offense when markets are turbulent.
Yeah, there's nothing that causes people to kind of take a step back and kind of think of where they're at, but volatility. And we've certainly had a lot of that. It seems like this market is pivoting up and down on every tweet, every news article, every headline. So it's important to kind of embrace what this really means. And to start, I want to just kind of set the framework here. We have many clients at Kaydan Wealth Management who are retired or very close to retirement. And in many cases, those clients who are retired are also distributing money on a regular basis to support their lifestyle. In that case, our approach to risk and volatility may be quite a bit different than taking a longer term view. And the reason is, not only is volatility somewhat harmful in the near term, but it can also lead to long periods of time before recovery. In fact, in my relatively short lifetime, there are at least two periods of time that I can remember or have been reminded because of history where we've had a decade of no return at all. Back in 1964 to 1974, and as recently as 2000 to 2010, the valuations of a typical portfolio didn't grow at all. Now, if you're a long-term investor, that's one thing. But if you're using your portfolio to drive cash flow every year for a 10-year period without having return, it becomes really problematic. So our approach to downside risk is a bit different with those who are retired. So with that said, if you are a long-term investor with a long time frame before retirement, before you have to turn that spigot on, then I think a lot of what we are going to talk about this morning is certainly applicable.
Let's start by putting this all in perspective. You've set the stage here. Volatility feels unsettling no matter when it occurs. But how unusual is what we're seeing right now?
It's really not unusual. Volatility is part of the market. It's part of investing. It seems like the last decade or so, we've had great return without a lot of volatility. It was almost as if it's a sure thing. I assure you, over a long period of time, that's not the case. In fact, over the last 40 or 50 years, going all the way back to 1980, if you were to actually look at the market and look at the returns on the S&P 500 over the course of each individual year, you would notice that on average, we've had about a 14% pullback on average just about every year. And that 14% pullback does not in any way equate to whether the market's up, down, or sideways. We've had those and they've recovered, and we've had some that have gotten worse. But that's the kind of volatility we typically see. Now, the good news is if you're saving and you're 2, 3 more decades away from retirement, volatility can be a friend. In fact, over the last, 90 plus years, the market, the S&P, has been up well over 70% of the time. And of those years where the market's up, about 2/3 of the time, the market's up 10% or more. But it's those big drops that we have to worry about in retirement. But again, if we're not facing that for another several decades, then we can embrace this type of volatility. And the recoveries can vary. They can be very short. Think of COVID. We were in and out of that and the market recovered, it seemed like within months. Or we could have these long periods of time, like these lost decades that I spoke about just a few moments ago.
So then actually, instead of pulling back, there's actually a case for leaning in, but again, strategically. What does going on the offense actually mean in this situation?
Yeah, if you really look at returns in the sequence of returns, really good days generally follow really bad days. These markets kind of snap back very quickly. So by leaning in, what we're really talking about is making sure if we have a long-term time horizon to stay invested and stay balanced. Make sure that the portfolio itself is reflective of a number of different asset categories. I'm a big fan of mean reversion, and the longer we're in, the longer we'll see some things doing really, really well, while others aren't. And then eventually those that aren't will start doing really well, and those that have done so well start to cool off. So maintaining a fully invested position over an extended period of time certainly makes sense for those people that still have decades to accumulate.
What about emotional decisions?
Yeah, by staying invested fully, we try to exclude all those emotional decisions. It's a longer term game when we're accumulating for retirement, much more so than short term. And if you think about it, a lot of the news that we have, a lot of the volatility on the market is so compressed, it is so short term that generally it's all of our goals are generally well beyond the effect that the short-term volatility generally has. So keeping the emotions out of the equation certainly makes really good sense.
All right, let's get tactical. What are some specific ways investors can take action?
Yeah, well, since the market has a little bit of an upside bias long term, it makes sense to consider front loading some of the investments that we typically make. If you have the ability, for example, a bonus early in the year, and you have the ability to do the lion's share of your 401k contribution earlier than later, that certainly helps. It even helps even more so if there was a pullback in the market and valuations are even lower still. It also makes sense to rebalance the portfolio, the old buy low, sell high. So the idea is if we have the ability to buy more, rebalance more when prices are low, we will generally ultimately at some point reap the rewards of that when valuations come back around. The other thing that we might want to look at is in terms of our contributions. If you think about it, and we're funding, let's say, every pay period, and typically we get paid twice per month, there are 24 opportunities to put some money to work. There's a huge opportunity in terms of dollar cost averaging. That is being able to buy at varying prices along the way. If we're doing that on a regular basis, regardless of the portfolio itself, regardless of how conservative or aggressive the actual investment balance is allocated, that portion that is going into the portfolio on a regular basis can actually be structured a little bit more aggressively. The fact that we have the ability to dollar cost average, the ability to not only participate in our own contributions, but in many cases, the contributions of our employer as well, we have the ability to tack that a little more aggressively to take advantage of the dollar cost averaging, to take advantage of the ebbs and flows with respect to the market.
What if you're sitting on the sidelines with cash? What should you think about there?
Again, remember, keep the emotions out of it, because if you're sitting on a lot of cash, there will certainly be periods of time when you either feel like you're missing out, or you have the FOMO or any of those things that generally just drive us nuts. If that's the case and we're unable to time the market, which we are, nobody can time the market, it probably makes the most sense to determine a period of time that you feel is reasonable, 6 months, 12 months, 18 months, and then dollar cost average in this cash over that period of time. That way you're not committing all the cash at a single point in time. If you're doing that and the market it drops significantly, you can accelerate some of this dollar cost averaging and put a bit more in. But regardless, if the market is just treading water or has an upward bias, we're buying in slowly over time. That really makes some degree of sense. We do the same thing when we have clients who have corporate stock. When clients have corporate stock, we try to sell a certain portion of that corporate stock every quarter. The amount we tend to sell is determined by whether the stock is trading kind of above or below its moving average. If it's trading above, meaning the stock is really kind of pricey to where it normally is, we try to take a bit more off the table. We sell a bit more of it. Conversely, when the price is really low, we tend to sell a little bit less. So in both of those cases, our actions are really predicated on what we believe is value. And when we think value is high, low price if we're buying, high price if we're selling, we take action and adjust the amounts that we're buying or selling accordingly.
But don't keep your money out of the market indefinitely?
Absolutely not. No. Unless it's emergency fund money, which we'll get to, or money that you plan on spending or writing a check on in the short term. Get the money invested somewhere. And it doesn't have to be the stock market. You can get a pretty good yield on bonds right now. Certainly, the expectation is bonds are going to give you a yield that's probably similar to a money market fund would be today. But if interest rates actually go down, as they would if the economy were to slow down, you're going to get some price appreciation on the bonds as well. And corporate bonds generally are giving you a higher yield than government bonds. So there's some advantage elsewhere as well beyond just simply the U.S. stock market.
All right. How about Roth opportunities? When you've got a volatile market, is that a time to take advantage of that?
Yeah. You know what? It's really interesting because with Roth, you can do a conversion, for example, and you can pay the taxes from the conversion. Or you can do a conversion for the total amount and pay the taxes separately. In cases where you're planning on doing a conversion, moving money out of an IRA into a Roth, and you're doing it or timing it when the market is really cheap and inexpensive, it allows you theoretically to move that much more capital because the values are now lower inside the IRA into the Roth, pay the taxes on the amount that you would have converted. And then you have this lower price stock sitting inside the Roth where when the market eventually does snap back, as it does over time, you're accruing all that price appreciation now within the tax-free Roth account. So that really makes a lot of sense. We need to make sure that we're aware of kind of the timing of this and where the market is relative to where it's been. The other is true if we're just simply making Roth contributions. If you're making a Roth contribution and it just so happens that the market is down, we've had a pull back or a sell off, and you're planning on making a contribution at some point throughout the year, it might make sense to consider making that contribution now as opposed to later to take advantage of those lower prices to where the same amount of dollars going in can buy that many more shares, which will then hopefully over time appreciate for you more so than buying them when the market's much higher, let's say later in a given year.
Sounds to me like you should really talk to a tax advisor here.
Well, that's true. You really shouldn't be doing any of this without talking to your financial advisor as well as your tax person as well. There are limited opportunities for do-overs. You don't want to do a conversion and then find out at the end of the year, oops, I maybe shouldn't have done one. Or you don't want to find out at the end of the year, boy, you probably could have gotten away with doing a conversion. That would have been a really smart thing to do. You need to have these conversations on a regular basis. They need to be fluid.
And what about taxable accounts? Is there anything available there?
There are, the same thing holds true, right? Whether it's a taxable account or a tax deferred account or a tax free account, buy low, sell high is kind of what we're attempting to do over time. But with a taxable account, you can take advantage of market weakness to, as an example, accelerate tax loss harvesting. And that's really important if we're realizing some of these losses. We now have realized long-term loss that we can then use either later in the year or in years to come to offset capital gains. That mitigates, reduces significantly our tax exposure. The other thing that we can do is to accelerate those losses and still be in a position to perhaps take advantage of a recovering market, is to consider the whitewash sale, which is basically this rule that says, hey, if I sell something and I take a loss, as long as I'm out of it essentially 31 days, I can buy it back in again. Now I still have the same position, but I also can keep the loss. And that works really, really well, especially in highly volatile periods of time.
When things are volatile, sometimes you look at your portfolio and you realize this isn't working. Something here is just, we need to change this. And how should people respond to that?
Again, less about the immediacy of the volatility, more about how it relates to the long-term goals and strategy you put forth. Things change over time. Certain positions, if they're individual stocks have a tendency to go through life cycles. Something that made a whole lot of sense at one point might not make nearly as much sense today, either because the company internally has struggled, or perhaps the competition has also changed and stiffened with respect to the company and some of its rivals. Maybe a company that you didn't choose in the same industry might today be a better choice than the company you own. And the same is true with general investment categories, whether it's large cap, small cap, US, international. The ability to adjust the portfolio accordingly with what's going on in the economy and what's going on in the world in general. Tax rates can have a huge impact on specific sectors of the marketplace and specific growth opportunities as well. So making those adjustments down the road really makes some degree of sense. If we have something that just isn't performing and something is performing a bit better in the same space, you may want to consider making the adjustment. But just because something is down and something else is up doesn't mean you sell out of the thing that's down to chase the thing that's up. Remember, I'm a big fan of mean reversion. At some point, the losers become the winners and the winners generally become the losers. So what you don't want to do is compound the error by simply chasing some degree of current performance either.
All right. Well, beyond investments, Jim, what else should people be checking on now?
Yeah. So there are a number of things that we need to kind of look at. It's always a good idea in times of volatility to take a step back and think about your emergency fund. Back in the day, we called it an emergency fund. I don't think there's any emergency that we would face that would require a normal amount of liquidity right away. I mean, we all have credit cards or lines of credit that we could use to smooth over the emergency and then decide down the road when it made more sense as to what we can do to shore things up and provide some degree of liquidity. That said, there's still a need for, let's call it a comfort zone. It's not necessarily an amount we need to have if the furnace breaks down or the roof blows off, but it's an amount that if we had something less than that, you might feel a little bit uncomfortable. You might tighten your belt a bit, maybe less dinners out, maybe less travel or vacation, or we'll put off some home improvements. But then if we get above this certain amount, you generally feel like maybe there's a bit too much sitting here, very liquid in a low interest rate account. Maybe I should be doing something different. There's no right or wrong answer. There's no real rule of thumb. It's what you feel most comfortable with. The industry likes to put labels and time frames on many of this, and people today still think of an emergency fund as 3 to 6 months worth of cash flow. If you're retired and you're pulling X number of thousands of dollars a year out, that emergency fund or that liquidity fund might not be 3 to 6 months. It might be 3 to 6 years, because from evermore, we're going to need this amount of money coming out regularly. And again, if we're trapped or stuck in a market that turns to be flat for a very long period of time, we might need every bit of that time before we see portfolios really starting to grow again. So that's certainly important. Beyond that, take a step back and take a look at your risk tolerance. How much risk are you really able to take from a stomach point of view without feeling uncomfortable? To that, you might want to take a look at risk capacity. Do you actually have enough money, and just how much of a loss could you suffer without having it affect your retirement plan kind of one iota? It's interesting. Those numbers can be quite diverse and different. There are many folks we know that have zero tolerance for any volatility, but they have so much money relative to their spend, they could lose a sizable amount of it and it wouldn't affect their retirement one bit. And also the other way too, right? Those that maybe are a bit compromised in terms of what they've been able to accumulate. And as a result, they're willing to roll the dice a bit and take on more risk. So they have greater capacity to stomach the risk in spite of the fact that they have very little capacity to accept risk. So it's important to really zero in on those things. And then the last is the allocation, your risk tolerance. That is all going to vary with respect to your time frames. And it's important to take a look at what those are. And the time frame or cash flow may change. When do you retire? Do you still have educational expenses to deal with? Do you still have a mortgage? At what point do those things drop off? And as those things drop off, maybe your risk tolerance increases. Maybe you have the ability to accept more growth in the portfolio than you would have been able to the first few early years of retirement.
Jim, what is your message to investors right now who are feeling uneasy?
Well, those who are listening that are a long way away from retirement, I would say just relax. Volatility is inevitable. Volatility can be somewhat temporary. Keep the long-term goals in mind and make sure that the plan you have, your plan of attack, can achieve those goals. You can take steps today that'll certainly help you in the future, whether that is reallocating the portfolio, using steps to better rebalance, or simply insulate yourself from some of these emotions. And last but not least, sounds a little self-serving, don't do it alone. There are plenty of firms out there. I know of one specifically that can certainly help you put a plan together and then execute the plan over the long term. That said, before we depart, a couple of quick reminders. First, investing always involves risks. There's no guarantee for return or protection against losses. And past performance is no indication of future results as well. And while we hope today's conversation has given you some helpful, important ideas, nothing we discuss should be taken or affected as personalized advice. This is really quite general. I tried to explain that at the beginning as well. And before you do anything, please talk to your financial, tax, and legal professionals before taking action on any advice or ideas.
As you've heard, market volatility, well, it can be uncomfortable. But as we've discussed today, it isn't unusual. In fact, it's a natural form of long-term investing. The key isn't to panic or retreat. It's to stay grounded, stay informed, and when appropriate, go on the offense. If you're unsure what your next step should be, don't go it alone. Reach out to a trusted financial professional who can walk you through your actions and your options. If you're not currently working with an advisor, Jim and his team at Kaydan Wealth Management are happy to help. You'll find a link in the show notes to schedule a free introductory call. There's no pressure. It's just a chance to get some clarity and support. If you found this episode helpful, please subscribe so you don't miss future episodes and share it with someone who could benefit. Follow at Kaydan Wealth on social media and let us know what you think in the comments. Your feedback and topic suggestions help us improve and make a bigger impact. And thanks for supporting our show.
Thank you for listening to The Retirement Engineer with Jim Kruzan. Click the follow button to be notified when new episodes become available. Visit our website at www.kaydanwealth.com or give us a call at 800-638-6900. The information covered and posted represents the views and opinions of Jim Kruzan and this episode's guests, not necessarily those of Kaydan Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.